What's up, guys? Today, Steve is going to be taking us through the actual numbers behind companies. This is a critical factor, and it is what distinguishes the winners and the losers. So, Steve, you want to take it over?
Yeah, sure. So the numbers is maybe not everyone's cup of tea at first. However, when you're looking for the actual value, that's where you have to look. At the end of the day, that's what really matters. So I'm going to simplify it as much as possible. It's going to be less than 10 minutes, this video, and you should be able to understand the basics of the financial statements. So let me just share screen very quickly. So, yeah. Okay. John, you can see my screen like this, right?
All good.
So these are the generic financial statements that every company has. There are three statements. There's the balance sheet, income statement, and cash flow. Let's start with the balance sheet. So what's a balance sheet? Balance sheet is basically everything the company owns, everything it owes, and what's left over. What's left over is basically yours to keep. So let's start. So on the left side, you always see the assets. The assets is everything you own. So like property, equipment, cash, stock in the warehouse, things like this. If it's current, it's something short term. So something like stock in the warehouse that you expect to sell. So it's a short-term asset. Non-current is something you expect to own for a long time, like a factory. Those are the things you own. Liabilities, again, non-current and current, so it's long-term or short-term. And liabilities are things you owe. One of the main ones is debt. If you have a loan, that is something you owe to the bank or you owe to bondholders, and that is something you owe in the long term. Now, equity is what's left over. Notice how the left column and right column are the same in height. That's because equity is basically everything that's left over. So if you had to get all the assets, sell them, use that cash to pay off all the liabilities, everything you owe, you're left with a certain amount of cash in theory. That's your book value. Now, you could argue that why isn't the company just worth as much as the book value? The thing is, this book value, the equity, it changes over time. So when you make earnings, when you make profits, that equity grows. So what you're expecting is that if you see a company with equity 20, maybe you're willing to pay 30 euros for it because you're expecting a lot of profits to come in the future. So this equity will grow. So it's not always the case that you just look at equity and that's what it should be priced at. Now, balance sheet is a snapshot of what the financial situation looks like at this point in time. So this is exactly what the company owns and owes. Now, how does this change over time? That's the income statement. The income statement will tell you everything you need to know about the change. So let's start with the revenue. Let's say you're a car company. You sell a car, you sell it for 10K, that's your revenue, 10K. Now, cost of goods is the cost to actually produce it. What does the metal of the car cost? What do the wages of the people directly making the car cost? Things like that. Gross profit is the profit after you account for those costs. So that's what's left over. Then you have other costs. So these are marketing, research, and things like this. So then you have operating profit when you account for those as well. And then the last few costs, which are interest and taxes and things like that. And then you have your net profit. Net profit is your ending profit. Now, this net profit is what goes into equity. Now, there are different ways it can flow into equity. So I'm going to share another screen with you to show you the different ways. Basically, there is reinvesting, there are dividends, and there's buybacks. So like this, just let me know if you can see the Excel thing, John.
Yep.
Good. So let's take above the line here. All here is what we currently have. So imagine the equity is 20. And imagine this company only has 5 shares. So each colored cell represents €1. So share number 1, it has an equity value of €4 per share. The same for share number 2 and all the rest. Now, let's say the profit for a given year is 10, and the company wants to completely reinvest it. So this profit of 10, if you divide it on over the 5 shares, you can, each share should get €2 somehow. So if it's going to be totally reinvested, this is what happens here. It's basically the profit per share just gets added to the equity share per share. So before you had 4, now you gain the profit of 2. So you add them both together, and now you have an equity value of 6 per share. This you can see is after the first page break, kind of the line. So where it says equity per share after reinvestment. Completely reinvested. So in that scenario, you're not going to be receiving cash in hand or any dividend like that, but your share price is going to go up because the equity value also went up. Now, what else can you do? Maybe you don't want to, the company doesn't want to reinvest the money. Maybe instead they want to pay you a dividend. That means just cash in hand. So you will still make €2 per share in profit. However, your share price likely won't go up. Because your equity value, you can see over here, it stays the same. It stays €4 per share. But then that €2 per share, the company sends it to you as a check, cash in hand. You have €2, go and spend it on whatever you want. So as such, you're making the same profit. It's just a different way of distributing it to you. Either your share price goes up when you do reinvestment, or else the share price probably remains the same and you get a dividend instead as another alternative. And then there is the last alternative, which is quite common nowadays, buybacks. Buybacks are, instead of reinvesting or paying dividends, we will buy some of these shares back. And when a company buys back some of its shares, as such, what it's doing is canceling some of its shares. So the numbers here aren't perfect, but let's say that €10 in profit, the company used them to buy share number 1 and share number 2 to cancel them. Now only shares 3, 4, and 5 exist. Now there are only 3 more shares left. So that means your equity value per share this year is not going to change. So you can say, look, you didn't get a dividend this year, or you didn't get reinvestment. So nothing really happened this year. However, what will happen? Imagine you continue making the same €10 profit in the future. In the future, that €10 profit is no longer going to be divided over 5 shares. Now it's going to be divided over 3 shares. So instead of making €2 per share profit, you are going to make 3 point something euros per share profit. So what you're doing is you're giving up any reward today because the earnings per share in the future will be better. And basically your equity growth in the future will be better. So those are the ways they can interact. Now, normally a company does a mix of them. So it does a bit of dividend, a bit of reinvestment, and maybe a bit of buybacks at the same time. So that is how the income statement works. Lastly, let's look at the cash flow. So when you have a net income of 10, it doesn't mean that your cash is going to go up by 10 as well. This is because maybe a company is earning a lot of money, it earns €10, but then it's spending it all on other things. It's spending on paying off debt, it's spending on creating new companies. So even though there's a lot of income coming in, maybe your cash might be going down. And what tends to happen if you run low on cash, then you have to find more money to continue your operations. So this can be a problem, especially if there's a company that has a lot of debt and it can't handle any more borrowings to supply its cash. It might lead to some problems down the line. And when we value a company, we tend to look at cash flows. However, that we will be coming to it later on in a different episode. So how does this work? You start with net income, the net income of 10, that's the profit per share. Then there are a bunch of items, either operating, investing, or financing. They're basically different categories of things that will impact cash, but not profit. So for example, if you invest in a new property, you're not impacting your equity value in the balance sheet because you're basically converting one asset, which is your cash. You're basically just converting it into a factory. So your total amount of assets will stay the same. So your total equity will stay the same. However, you still have to fork out that money. So cash still left the company. So because of that, you might have investing cash flow -4. So that might mean that exactly cash left the company. So the change in cash is basically the net income plus the change from these 3 categories. So we have a change of 4. So that means that although income for the year was 10, the actual cash we brought in was 4. It's still an increase, so that's still pretty good. But this is something you need to watch out for, especially with a lot of the ratios in the future. Now, this is the basics of our financial statements. If you look at them on any financial statement you find online on the website of the companies, they will be quite a bit more detailed, but these are the basics of it. Now, from all these numbers, you can derive a number of ratios. Those ratios are what you start to compare the companies, and that's how you can start to tell which are the good ones, which are the bad companies to invest in. So we will be covering that in the next episode. For now, this is it. We will probably be adding some more ratios either in an article covering this episode or a future one. But if there are any questions, just please let us know. Thanks for now.